to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today, we're talking about how data AI and investor behaviour are reshaping the property market. My guest, Jordan De Jong, works with a platform that sees a huge share of buyer's agent transactions across the country, which means he's got a front row seat to where investors are actually putting their money. We unpack a growing trend where more data isn't necessarily leading to better decisions. In fact, it might be doing the opposite. From heat maps and hot spotting to the idea that when everyone is chasing the same suburb, you're probably already too late. We also explore how AI is changing the game, what it can do well, where it falls short, and why the human element in property investing still matters more than most people think. If you're trying to cut through the noise and avoid chasing the herd, this one's worth your time. Here's Jordan. Jordan De Jong, thanks for joining me back on Geared for Growth.
Mr. Mikey Mortlock, it's I don't know, I think this is my third appearance, and I reckon our original one would have been like 5 or 6 years ago now. It's crazy.
I think next year is actually a 10-year anniversary of the show, which is kind of crazy. Wow. And I remember when I started thinking, this is a bit embarrassing. Like, I'm so late to the podcast party, but now I look like a genius early adopter. At least that's what I'm telling myself, mate. But it's always good to have you. Thank you, sir. It's always good to have you back on the show. And we sort of plug into you as our resident sort of tech AI guru. And of course, with the platform that you've built with Gameplans, it's an intelligence, almost like analytics style platform now, just with the sheer quantity of data. Maybe sort of starting with that. What sort of market representation do you have for buyers agents, and do you have any idea about what sorts of transactions on a yearly basis you'd be analysing?
Yeah, it's quite funny to see the growth of the platform and the user counts. Like, we can get into the transactions from like, if you haven't heard about Gameplans before, we essentially work B2B directly with buyers agents. That's our segment. We roughly estimate there's probably 800 investment-focused buyers agents. So we do work with some owner-occupier buyers agents if they do want to buy investment properties for their clients. But of the 800 we work with, last I checked, about 550 or 560 of those, which is about 67% of the market. So we do see quite a lot of transactions that go through buyers agents. We work with some of the biggest buyers agents in the country, and we're fortunate enough to have that data and see that data come through. And so, yeah, from like a growth perspective in terms of transactions, I think we've grown by 1,000 or 2,000 users this year alone. So we're in March, nearly in the end of March, Q1. And so, yeah, you can quite imagine, that's what, 300-400 users a month that are doing transactions on property through the forecasting tool and building out things like that. So we're very fortunate with some of the data that we get to see and what's coming through, where people are buying, what they're buying, all that sort of stuff.
And of course, a bunch of that, a bit similar with the data that we collect with investors where they're buying around the country. There's some secret sauce for particular buyers agents, but we can sort of speak to big trends. For example, last year we saw the Townsville SA3 location top all of them. This year, I've sort of had a peek into the behind the curtain of our data. I'm seeing places like Ballarat that are just jumping off the spreadsheet at me. What have you sort of observed over the last couple of years about investor movements and behaviour?
Yeah, it's very interesting. So a lot of people have brought up this issue recently of these quote unquote larger buyers agencies that have, a number of clients that they need to buy for every month, and hats off for them for being super successful and needing to having that many clients in the first place to buy for. And they quite often complain about like, oh, well, if they've got, 50 clients to buy for and they're all buying in one particular area, of course that area is going to boom. But the thing is, those bigger buyers agents are generally buying in 5 or 6 different locations, probably even more at any one point in time. So it's not like every single one of those clients are going in. I think the bigger problem is probably the data houses that are out there that are generating reports of like heat maps or hotspots, because these little kind of like circles or bubbles that they've got on these heat maps look bigger. And so everyone who's looking at the same graph, look at the biggest bubble and go, oh, this area, everyone's buying in Ballarat. And so all of the buyers agents that are using that tool, plus all of the consumers that are using that tool are probably looking at the biggest bubble, clicking on that and going, well, this is the hottest thing under the sun. And then that bubble in the graph gets bigger and bigger and bigger. And it's almost this kind of like self-fulfilling prophecy. And so I would say it's more of everyone in the industry itself than like one particular buyer's agent. Well, that's how I perceive it and look at it, getting to work with guys so closely all the time. And when you think about even, and I know this is a property focused podcast, but you think about like stocks or crypto or everything else like that, the worst time to buy is when everyone is buying. Like, be fearful when others are greedy and greedy when others are fearful. And so when you have this self-fulfilling graph where this, percentage bubble is getting bigger and bigger and bigger on a particular suburb, generally that means that a lot of people are buying in that area, which have already inflated the prices. And you never really want to be the last person into the area. And what I mean by that is, if you look at suburbs that have grown at an abnormally faster rate than typical markets, so Australian average over the last 30 years is 6.8% annual growth rate. If you're looking at a particular suburb and it's grown 15+% in the last, say, 12 months, it's not like that growth it may continue. Like, I mean, there's some suburbs that we've seen that have grown like 20, 30, 40% in 30 years, and it may happen. That's great. But when it's grown, my cautionary level is like 15 to 20% in a 12-month period. What we generally see is that growth has just been brought forward. So instead of that 6.8% or 6.7% being over 3 years, it's now all been brought into that 1 year. And if you're buying on the back end of that 12-month or 18-month period, you might be buying at the peak and you might not see a decline, but you might not see any like further growth for another 2, 3, 4 years. And the opportunity cost of that is quite large, if you were to get into the other areas that do have more growth. So it's more of an industry at a whole and the particular tools that people are using to look at these kind of heat maps and go, let's shove everything and put all our chips in this big one basket. And that's what kind of brings that growth forward.
That's an interesting concept, and it immediately made me kind of think of caffeine, right? Like, if you have caffeine, it doesn't give you energy from the universe; it just steals it from your future your future self, right? Like, you'll pay for that later, and that kind of makes me think about, sure, like a market can do 20%, but it's like, okay, well, over 10 years, maybe it was going to do 50, 60%, but it's already spent some of that energy. And that's a big concern for me with markets like, I suppose, Perth at a point in time, although that has been like a performer for a number of years. Maybe Darwin is a good case study. And perhaps I think we're starting to now see the rise of places like Hobart, which could have that same sort of cycle where you get the big property forums, which didn't exist really 10 years ago, the data houses, which did exist, but not the way that they are now. What do you think has really kind of fundamentally changed about the way we're investing in property than, say, 10 years ago?
Yeah, it's funny you mentioned Darwin and Hobart, because my main concern there is, if there are a whole bunch of investors going to this area and they're bringing incomes from Sydney, Melbourne, Brisbane, larger incomes with bigger borrowing capacities that have the ability to push up these prices, what happens when those investors stop to flow in those areas is all you're left with is the locals. And the locals, depending on the local demographics and economy, might not have the income which reinforces the borrowing capacity to be able to afford those particular areas. So they actually get pushed out into bridesmaid suburbs and, pushed further and further away from, their mum and dad and their home and where they live. And so that's where you have these flat property prices for like 5-10 years, because you're just waiting for the local incomes to increase at a rate where they can increase their borrowing capacity to buy those properties, or you're waiting for investors to come back. But on the last 10 years, so I say when I started investing 10 years ago, and there was definitely a lot less data available in the market to see. I think it was very common. It was still quite common there to, have, and it's still common today, but have the barbecue conversations of, Uncle Jeff's done really well out of property. He's bought in the suburb around the corner and it's grown by, it's doubled in value in the last 7 years or whatever it might be. And I think, when I first started reading things like Steve McKnight, that was kind of the general consensus, is like, all property is great, just get in and keep buying and keep going. But I think over the last 10 years, we are so rich in data now and have access to so much more data, and everyone starts to make data-driven decisions, which I'm a big fan of, being a tech guy. But when everyone is looking at the same data, that's when we have these euphoric moments of everyone going, oh, this is the next best hotspot because of metric of owner occupier versus investors, metric of owner occupier appeal, metric of walking distance, metric of X, Y, and Z, whatever it might be. All kind of align, and everyone has these general consensuses of, well, these are the quote unquote metrics that we follow to get into these particular areas. It green signals everyone, and everyone goes, oh my gosh, this is the place to get into and the place to be. And then, again, we now have, as you said, those forums online and the places where people hang out, Facebook groups, and they all start to talk about these particular areas. And again, it's that like kind of self-fulfilling prophecy of where's the next best hotspot. And unfortunately, and we get this in the strategy piece too quite a lot, where people are like, buy 10 properties in 10 months and you'll become a millionaire overnight. Now, I know that that's not true unless you're, earning $2 million a year or something like that. But the same thing applies to marketing and hotspots. Like quite often you'll see advertisements of like, these are the next biggest 3 boom locations. And like, everyone kind of markets this. You need to get into these particular areas as soon as you possibly can. And I understand from a business perspective, because I do run a business, like you want something to create secrecy, urgency, desire, a way for people, a way for people to come exactly. It's a way for people to come and work with you that's different to everyone else. But in doing so, you're kind of creating this like drive to get into these secret areas, which are, of course, never secret. It's where everyone's investing, but it just does drive this kind of desire of like, well, let's get into the next best hotspot before everyone else does. And generally, and you'll like, if anyone's a crypto investor in this thing, you'll generally know the peak of the market is when mum and dad are talking about Bitcoin on the dinner table. So when everyone's talking about the same suburb or the same thing, it's generally already it's already a hotspot. It's already too far gone. So yeah, over the last 10 years, I'd say property's transformed from, a very, not that it's not safe now, but a safe, leveraged, brick and mortar investment vehicle with a rental income to now some particular people that are chasing kind of like, the stock market. You'd be chasing these stocks that are going to be these next boom locations or these next areas that are going to grow massively. And look, I've seen people do extremely well out of this type of scenario when they tack it on with like, an area that's going to grow by 30% over the next 24 months, plus they do a renovation or add a granny flat, plus they do something else to uplift the value. Like you can really, triple whammy these things to see some massive growth, and then they either, pull the equity out and go again, or they sell it and go again into the next area. But it's a very active strategy, and I think we've probably seen a lot more active investors come into the space over that time.
I have a bit of a hypothesis that property investors today compared to 10 years ago, a little bit less patient. It's almost like if I'm working with a buyer's agent and you don't get me 10 or 15% growth in the first 12 months, it's almost like I want my money back. The whole get rich slow stuff that maybe, you and I were talking about off air of, some of the experts 10 years ago, that's kind of dead now. And I wanted to ask you mentioned Gameplans obviously is B2B, but when you started building the platform, it was off the back of you doing thousands potentially of strategy sessions for buyers agents, testing what works with people. How do you actually build a system that helps them deliver on their goals? And you still do that for some agencies at the moment. I'm wondering, what are you hearing in the strategy sessions today from the investor that might be different from the beginning of Gameplans?
Yeah, that's a really good question, actually. So I think it's particularly around the lending side of things and how lending has changed over the last 10 years. So again, if I take back to my early days of reading Steve McKnight, he bought 250 properties in 3.5 years or whatever it might be. And he had the ability to do that based on the lending landscape at the time. You could buy things in trust structures. It was quite easy to hide things. You could have 4 different trust structures, have a loan with 4 different banks, and then set up another 4 different trust structures and go back to the same 4 banks, but they wouldn't even know you were the same lender. And as long as you could prove income and that the properties were self-sustaining, you could go again and keep lending. And so
good old days, huh?
Yeah, mate, that was the dream. I used to go to bed every night going, I can't wait to get to 250. But along my journey, I learned that things had changed. And what I mean by that is property number 1, I bought on my personal income. Then I got married and had a spouse's income, so I was able to leverage that and buy property number 2. Then we're lucky, property 1 and 2 grew in value. We pulled out some equity and our incomes grew because we were quite young, and we bought property number 3. Went to the bank for property number 4, and Mr. Banker said, not anymore. And I said, what do you mean? I want to buy 250 of these things.
Yeah,
And so,
Steve said.
yeah, exactly. And so the whole lending landscape has changed. And I think it's for a good reason. We want to, the government wants to make sure everyone's doing the right thing and not, buying 250 properties on the same 100K income for all 250 of them. Like, it makes sense. But how that now changes how people build out a portfolio, it's not just completely residential focused. There are different other asset classes that people do now promote a lot to get into. And that generally comes in the form of commercial. And so what we see now as a general way to structure a really decent portfolio for majority of income earners is typically it starts with one fundamental good foundation property, which is a good capital growth property. Again, you want to be targeting at least that 6.8% on average over the last 30 years. Once we have that, we start to leverage the equity that comes out of that property into property number 2 and number 3, which is what we call momentum type properties. So they are still growth focused, residential focused, but they do generally need to have a higher yield to underpin the loan that's coming through. It needs to be a little bit more self-sustaining, and we don't want to be hemorrhaging, 20, 30 grand a year towards a property portfolio if we're earning 150 grand. It's a large portion of our income. So we do need to have some, it's harder in this environment with a higher interest rate, but we want to at least have some cash flow coming in. It might be just a little bit negative, neutral, or positive if we can do so. And then we see most people cap out at 2 to 3 properties. This is what all the data says, with the ABS and everything else like that. It's what we see at Gameplans as well. But then what probably has changed the most over, I'd say, the last sort of 5 years, as people are now moving into that commercial sector as well at the end of the portfolio. And the reason they do that is you can get different types of loans for commercial property. What I'm talking about is a lease doc loan. And what that means is, as long as you put a decent deposit down enough, like a 30, 35% deposit, sometimes could even be 40, depending on what lenders you're using. And the property itself has a decent yield and it's self-sustaining, then they don't necessarily need all your income statements and need to see all the nooks and crannies and make sure it's verified and everything else like that. As long as the property has a decent amount of, a lower amount of equity about in it, so you've got a bigger deposit in it so that it's not seen as risky, plus it's paying for itself with a rental income coming in, they're quite happy to give you this quote unquote lease stock loan and help you continue lending on your journey so that you're not just capped at the 2 or 3 properties that we go from there. So I'd say most people can now achieve their goals, that quote unquote goal within sort of 3 to 5 properties, depending on how big and how much income you want the portfolio to have.
Interesting. And I suppose people would say, look, if you've got 30% of the deposit for a commercial property, then you should be able to get a residential. But the difference is that you might have a deposit, but you don't have the serviceability that the bank's looking at. And really with these types of loans, they're saying, well, that commercial property is servicing itself.
Exactly right. And to just for the listeners who might be listening to this or understanding what borrowing capacity is for the first time, generally you can borrow, right now might be a little bit tighter, but generally you can borrow about 6 times your income. So let's say you have a household income of 200K, you should be able to borrow up to around 1.2 million. So say you bought, 2 properties at 700 and got debt of, 550 on each of them. You've got a $1.4 million portfolio, you got $1.1 million worth of debt, you can borrow up to 1.2. So really all you can extract is another 100K to make the banks comfortable. Now you might extract that as a deposit for a commercial and build it out from that way. But the typical lending with the big 4 banks isn't going to be enough for you to buy another 700K property.
Now, I want to change direction because you are a tech wizard. And I think the last time you were on the show, we were actually talking about machine learning and artificial intelligence pre-OpenAI, I think. So, again, early adopter, genius, innovator. I'm just
how that landscape's changed since then.
I know. And I want to ask you the question of where we're at the moment. And a conversation that I've been having with people lately is all this talk about AI taking people's jobs. And it's oh, good, it went after coders' jobs first. And I'm like, no, it doesn't sit there and go who am I going to punish first? But it makes sense when someone sort of explained to me, well, AI is code, right? So why wouldn't it become the best it possibly can as code? Because I think OpenAI and Claude have said their latest updates were the first ones that were meaningfully created by AI itself. So it's not come after coders. It's just coding is that magic. Now, you're a software developer. You're a coder. I can see in your background, you've got a lovely little bookshelf and you've got a vase, and obviously none of that's on Facebook Marketplace. You're okay. Like, what's going on? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so I look at this the same way as the Industrial Revolution. Like, you know, when we were farmers and farming all day, and then the machinery came in. Well, now we could just farm a whole lot more with utilizing machines and using and things that would help us do that. I see it in the same way now. So, for context, I have a team of developers of 6 who work on about 8 different projects, and what I have been able to see is those 6 people are now a heck of a lot more efficient. So I'm a software developer myself, and I love using the tools. They're making it efficient. They're easy. They do probably 80% of the heavy lifting. I still need to go in and do the 20%, check that the code that they've written is actually legitimate. It works. It does what we're saying. There's no bugs. There's no injection of malicious activity or anything else like that. And it's the same thing with the developers. They can be a lot more productive now. We can get a lot more done. They can be a lot more active, and they're using this quote unquote machinery or tools to help them do 80% of the heavy lifting, get all the stuff that used to take them hours to do. They can now do in minutes, but they're still there checking the code, making sure that it works, putting it into a production environment, testing it in a live landscape. There's always going to be a need for someone to kind of man the machine and do all the checking. As a business owner now, not being in the trenches of building software every day, I still need someone that I can rely on and trust who can deliver that production quality deployment, but utilizing the tools to help them build it much quicker. That's how I foresee it. Now, I know a lot of people in the tech space are loving the fact that you can get like OpenClaw or Claude Code on, you know, Telegram or WhatsApp. And so, you know, right now I could be out for a walk and then think of an idea and go into my WhatsApp and go, hey, our AI assistant, can you add this particular feature to my system, and then deploy it? And so it will actually do that. It'll receive that request, go and program it. It might send back any other questions or anything it needs, then go fix it up. It might even do some bug testing and playing around with it and making sure it works. And then it will push production for you. So you can have this whole streamlined thing where instead of me sending a message on Slack to a developer to go and do that, you can actually go and tell AI to do it. The biggest concern for me is obviously there is no kind of like final checklist or final production. It'll probably produce code better than a software developer would, which is what we want. But does it actually do the thing? So I think the hardest thing for us is going to be as software developers is go like, and I think like prompt engineering has probably become a non-reliant job or anything else like that. But actually articulating to these models what we want it to do, and it having full context of what the software already does, and then implementing the new feature change. Because sometimes we don't articulate in the best way what we actually want the tech to do. And most times, this is how I learned to code, is just through trial and error. You know, I'd go and build something and then I'd test it and it wouldn't work. Then I'd go back, change something, test it, wouldn't work, and then change something again and I'd finally make it work. I think that like repetitiveness is always going to happen. It's just you're not spending the hour or two trying to fix the thing that's broken. You're sending it into the code and being like, hey, can you go and fix this or change it this way? Because you sometimes, and this is what I've noticed, is you go and build something that you think or that you sought out to go and build as a feature, and you love it, but now you see the technology in a different way. You see the feature in a different way. And so you go, actually, that's really cool, but what would be even cooler is if we did this instead. And so I still think you're always going to need that kind of human element or human oversight or person who runs the machine to go, this is what we need to do, and go forward from there. So you're definitely a lot more, as a software engineer, you should be definitely a lot more efficient with software itself. But there's definitely like with that, you'll now see. I know, Mike, you've built a pretty cool tool in the time using some tech that's out there as well, which is awesome. And I think now we're just going to have the ability to see people build all sorts of technology that's out there, even like businesses that are in-house, small businesses can build their own unique CRMs or own unique little technology that they need to and is useful from them. And then there's two sides to that equation. The first one is, are they going to be bothered to maintain the thing when there's new features that come out? And, are they going to have the time to do that, the resources to do that, everything else like that? Saw a really good post the other day. I think it was Frank Grief who's building Kinzo. He said, like, one of my staff members went and built this tool, took him 3 hours, cost us, I don't know, let's say $60 in tokens, da 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 da. It was really, really cool and worked straight away. It was really fast. However, there's already a solution on the market that's $40 a month. So we've already spent $60 in tokens and spent 3 hours of this kid's time doing it. Like, why wouldn't we just go and spend $40 a month that already has a better solution, that's always getting updated, that always has features, et cetera, et cetera, et cetera. So there's a catch-22 in doing that, especially for small business owners. The second part of that too now is we're seeing people like Apple actually decline vibe-coded apps on their app store. So there might be an emergent of a whole bunch of apps that are out there, but now there's going to be bigger moderators and bigger gatekeepers that are actually like, well, hold on, it's cool you've built this thing and that's awesome, but we actually don't know how these things work or what is built or if there's any like malicious activity that's behind the scenes. And so they're declining a lot of vibe-coded apps, which is great. It's great for the industry. I think it's really good that people can go and build prototypes and go and build demos and do it in the space of a couple of hours and bring this. For me, the light bulb moment with technology was being able to tell the computer to say print hello world, and it brought up the browser and printed hello world. Like that for me was like, oh my gosh, I can tell the computer to do something. And I think right now everyone is going through that same exact experience, but you can do it in English. You can be like, hey, computer, build this CRM for me and do X, Y, and Z and make sure it connects to Zero and connects to this and that. And it does it for them. And they're like, oh my God, light bulb moment, this is going to change the world. But then they don't realize all of these nuances of like, well, to actually get something production ready, there's probably a 1,000 different pull requests. A pull request is like code updates that need to happen before like proof of concept to actually getting it to production ready. And so there's this vast difference of like that light bulb moment and oh, this is so cool and it works to, okay, there's probably a number of different things that we actually need to think about and update and move forward from here. And then on the other side of that, there's the coding piece. And then, sorry if I'm wafting, but there's the, uploading it to servers and maintaining domains and, all those technical things that AI doesn't really do for us yet. It can, it can help with that and give you guides and suggestions to do it. But if you're coming from a complete non-technical background and getting these step-to-step things of like how to change a DNS or how to update through Heroku or how to push your master branch to, your AWS master branch and create a database, like these concepts alone might be quite foreign to people, let alone going out and actually building them and doing them. And so the tech will get better and help you along the way, but there's still a number of components and elements to the entire process that I think you still need someone to man the machine. They can just do it a lot more efficiently.
No, I think that's a great synopsis of where we're at the moment. And there'd be so many people building so many things at the moment. I met with a mate of mine and we're basically having I'll show you mine, you show me yours session, and some of the stuff that he was doing, he's put all of his like health biomarkers and he's built his own basically GPs. Like, I don't need a doctor anymore. It's only when I need a script. I'm like, oh my gosh. Like, and he's like, I've got ADD and it used to be like a problem, but now it's a superpower because I can do all of this stuff. And it's like, the challenge is more about like, what do you do when you have 15 concurrent world-changing products, and what do you actually sort of pivot into? It made me kind of think about implications for the property space, because there'll be a lot of people building a lot of things. I know we talked a little bit about those data houses, and I've always been a little bit sort of healthy skeptical, which I am with everything in life, about the short-term metrics that it seems to to be prioritizing rather than the long-term stuff, which is a lot harder to get and with a lot more accuracy. But what do you anticipate to be happening in the next 12 to 24 months? Because we've been talking about like AI, buyers agents tools, AI, hotspotting, or, basically use our algorithm. It's going to pick that there is actually one property in the whole of Australia that is ranked number one for growth in the next 12 months. I mean, I was actually hearing somebody say that maybe 10 or 12 years ago. Now, you don't need to be a coder like you. It's been sort of democratized. I know you shared a number of reasons why, like someone ham-fisted like me is not going to outperform you when it comes to the architecture and the robustness of what's actually being delivered. But it does sort of seem like a hell of a time to be alive. And I'm interested to hear your thoughts from the property sphere. What do you think will be something that the consumer can access, and will it be the panacea that a lot of people may promise that it is?
Yeah, spot on. I think a lot of companies have tried to tackle this pre-AI as well, where you kind of have no need for a real estate agent. A buyer's agent really has only become quite popular in the last 6 years. So, and I think people have tried to tackle this as well, particularly around like the whole off-market component of having buyers and sellers come together without a form of representative. And I think where they've failed, and I think where tech will fail as well, is even if I was going to sell you my house, Mike, and we both did an analysis and a CMA, and we said, okay, it's worth $1 million. We might do all the same analysis, but I might still land on it being worth 1.1, and you might still land on it being 950. And even though we've come together, we've decided that we want to sell, you want to buy, we might not come together on price. And you kind of always have to need that third party to help negotiate and buy for you, especially if it comes to something like an owner occupier. Biggest thing that comes to mind for me is like an auction environment where you've got a father bidding on behalf of their daughter and wanting to buy their dream home. Like that father, I guarantee you, I've been to that many auctions, will always pay, 5-10% more for that asset just because their daughter really, really wants it. And they're cashed up. They've got the pockets if they're competing with other people in the same age demographic, but daddy's there with, the bank of mum and dad. Like, of course he's going to pay more. So there's going to be, number one, always wanting an actual representative who can negotiate and talk on your behalf, so you don't have to have those awkward conversations or really know what you're getting true value for it. Secondly,
you know when to walk away too, right?
Exactly. And I think most transactions actually need someone to push you across the line because it's a big decision. So, for me, if I know I can get 1.1 and you balk and say, oh, I'll come up at 1.025, I'm still going, oh, I really want 1.1. But in reality, the difference on what's left, it's much easier that you're here, I'm here, we're both at the party. Maybe I need to be pushed a little bit to just make the sale happen. And I think that element is still going to happen as well. So that's where those prehistoric companies have kind of not failed, but haven't been super successful in that demographic. And I think the same thing will happen with AI. We're going to be really rich in data. And Mike, you had a really good point there before around data points and it being a point in time. So when you think about things like a rental yield or an average rental yield of a particular suburb, really that's right now. It shouldn't really factor in what the suburb's going to do in 5 or 10 years because the growth rates might outpace the rate of rent and yields are going to be completely different. And so, we are quite data rich right now, and AI is going to have its teeth and its claws in that data richness, and it's going to make assumptions based on that data and go exactly as you said. This is the best perfect suburb to invest in. That's going to be the next biggest hotspot and absolutely take off of that suburb. There's this one particular house that's always performed really, really well. This is going to be that one property. But I guarantee you, no matter how many models you run and forecasts you do, it's actually not going to be that property. It's going to be somewhere completely random and different that actually has the best opportunity. And it's just because, data, as good as it is and as helpful as it is and as insightful as it isn't always 100% correct because it is mostly outdated. It is driven still from, real estate agents giving you correct and accurate data, them saying that this is what it sold for on auction day, or this is how many people rocked up to auction. Like all that sort of stuff is still manual from the agent. Yes, technology helps in terms of they've got CRMs, which they can feed that data from. But, we are in still a human-driven space from the data that it originates from, and people can lie on data, people can forge data, people can give things wrong. And so it's not always going to be that 100% accuracy. And we've even seen this with like AVM forecasting tools. There was a tool that came out that got bought out from Domain. I think it was called Real As, and that was probably the closest accuracy that I've ever seen from an AVM. And even that was still kind of 2 to 5% out. All the other tools that are out there that give AVMs will give you that, kind of lower and higher range and then middle range, but the middle range is always 5 to 10% out. And so we can't even forecast values correctly, let alone what the best next suburb is going to be for growth rates and everything else like that. Down in the negative side of things, the positive of that is having AI and that data available to AI. We're going to now have that same instance where not longer need to message your buyer's agent and say, give me, your 5 reports, and then they have to go off and build the 5 reports and find the data and make it selective to you and your brief, and then hand it back to you, which could be a week and a half process if they're actually making it from scratch and not have kind of these like predefined PDFs. You can now go and create an AI and be like, hey, this is my brief. This is what I'm looking for. Now match me or show me all the top 5 best suburbs that match my briefing criteria. And it's going to give it to you instantly, which is really, really cool. You're going to have that data at your fingertips. You're going to be able to make informed decisions and have insights that you couldn't have had before immediately. And I think it's just going to give everyone access to do a whole lot more at any point in time and build it out from that side of things. The downside of that is there's going to be a lot of analysis paralysis. Like there might be too much data at your fingertips. That's going to make it even harder to make a decision. And so again, I think that's where that human element is always really going to be needed to be like, cool, AI has showed you these 10 suburbs and they're going to be the best thing. But, this is why I would disregard 8 of them. And maybe these 2 might be legitimate. And here's another 2 that we're actually done some really deep dives on that might be more legitimate that you think about as well. And so people are going to be overwhelmed with the amount of availability of data and information. And given the way that I've seen AI still, even with the updates that are coming through now, hallucinate in some way, shape or form. So people talk about the different models. You've got Claude, you've got OpenAI, you've got Grok. Something that I've noticed with, let's say, OpenAI specifically, is it is your best friend. It'll say, you are a genius. I can't believe you thought of that. This is going to be the next $1 billion company. You're going to go build this technology. I'll build it for you in half an hour and it's going to blow up. And that's great. That's nice. That's what we like as humans. We like nice, positive feedback. But if you can imagine that in like an investment landscape and saying, you are so correct. This is the best suburb. There's no other better suburb in the country that's going to be well. That's actually really dangerous from a recommendation point of view. And it is hallucinating in a way of trying to create it upbeat and positive, which is what we want. But the downside is if you take that information as gospel and don't do thorough research and get a third party to help you, it could actually hinder the performance of your portfolio or that individual property that you buy over the long run and may not be the best decision overall.
That's an interesting point. I remember hearing a buyer's agent say when the client was sort of tossing up, put it out there to say, like, do you feel confident that that person is going to tell you to pull your head in when you are not behaving? Which is an interesting point, right? Because ChatGPT, I don't know if you saw it, but there was a semi-famous kind of instance where someone said, I've come up with this brilliant business plan and it's poo on a stick. And it came back and said, that is brilliant. We can do merch, like we can franchise. And it's like, okay, like this thing is literally just programmed to please and doesn't know when a bad idea needs to be hit on the head.
Exactly right. And that's my point in case. When you apply that to property investing, it's the same thing. Like if you give it this house and brief and data, it's gonna give you good information, but is it the right information or the best information that you can have at your vicinity? Like I don't think that AI, they don't have boots on the ground. They don't have 10 years worth of experience actually transacting and negotiating and talking to people. It can read, Steve Voss's Split the Difference books. It can read all the information data online about negotiation, everything else like that, but doesn't know how to negotiate in, Bundaberg with a particular real estate agent that you've been working with for the last 10 years. No. And so that's where that human element and connection and rapport and reputation is still invaluable compared to just working with an agent.
Just also to put your mind at ease, mate, having seen your house, I'm not interested in haggling. I'll give you the 1.1 and we'll call it done. Now, to finish up, mate, I want to sort of leave listeners with perhaps an insight from you as to what you're seeing within the platform of the people that are getting it right. Obviously, you've got access to a lot of data. I know Joey's been doing the rounds for Gameplans, talking about like who are the 10 percenters, who are the 1 percenters, what does it look like? So is there a way that you can weave that into a nice little red bow around what you think people really need to be focusing on for 2026 to get the most out of their investing journey?
Yeah, this is going to seem super generic, but I think when it comes to planning, and this is exactly why we do what we do, it's about building a plan and sticking to the plan. I think where we see people go so far wrong or derail or get distracted is when they chase the shiny object. So as I was saying earlier, when we see this marketing of these next best boom suburbs or 10 properties in 10 months, here's the new strategy on how to do so. It's very easy for people to get distracted, and they might have set a plan in place that was, as we said before, growth and then momentum and then cash flow. But they get to property number one, they go growth, and then they, see some marketing spiel of someone getting into this rooming house, which is generating a 12% yield. And they go, oh my God, like, why wouldn't I just get in that? It's making bank. So let's get into it. And they get into that and they get distracted and they realize, well, they've actually got to manage 12 tenants now. And then they've got all these sorts of maintenance issues because, it might be a lower quality demographic of people that are coming through. And so they're damaging things. Like there's so many different things that we see people, and again, it applies to like off the plan apartments or house and land estates. Like these guys, these developers, they want to sell you their product. They want to sell you their property. That's their job. That's what they're doing every single day. And so it's great that we're in, it's great what you do, Mike. And it's great that, we have podcasts and education and we're trying to get the best information out there. But if you aren't educated and you aren't doing research online, don't get me wrong, I've seen people do really well out of off-plan apartments and house and land estates. But if you're getting marketed these things and get derailed and get sidetracked, it's very easy to do so. And lose focus on what your longer term plan is really going to look like. So to wrap it all nicely, I would just say actually sit down, understand what you want out of property, whether that looks like generational wealth for your kids because you had a hard upbringing and you don't want them to have the same upbringing, whether that's, you're in your 20s and you want to retire at 30 and just go as hard as possible over the next 10 years. Or whether that's, you're in your 40s and resetting life and, just want to get to a position where you're financially comfortable again, like sit down and figure out what that actual thing is. What the biggest mistake we see people make is wanting to retire on the income that they're currently on. So let's say they got a decent, big fat income of $300K a year. And they go, okay, well, I've got 3 kids in private school. I've got, the missus loves going to Europe every year and that's 50 grand. Our mortgage repayments are $12K a month because we live in this mansion and all these things. And they go, okay, so when I retire, I need the $300K. And that's ultimately not true because those kids are going to grow up. They're not going to be in private school anymore. You probably, have had enough of going to Greece every year and you might want to go somewhere else and somewhere different, maybe more seclusive. You might still want to
maybe.
Exactly. And so actually sitting down and go, okay, well, the retirement goal is 11 years and we don't actually need 300K. We probably need 210K to be very comfortable. And so that's what you start to target and put your work towards. You reverse engineer that. You have your plan set out of how you're going to get there. And then you execute on every step of the way on that plan. You don't derail, you don't, change, you don't maneuver and move around. You don't see, Tesla's about to take off. I'm going to go put, that 100K of a deposit I was going to use for a house into Tesla. And then, it goes down and the cash is stuck there because you don't want to pull it out for the next 2 years. This is stuff that we see all the time, particularly in crypto as well. We see heaps of people get into crypto and I need to put 100 grand into crypto. And they get in at one of the highs and I'm a believer in crypto long term, but it comes down 70%. They freak out. They don't want to take the cash out because they're in a lost position. And then the opportunity of that sitting in crypto for, a year and a half, 2 years till it comes back up again, it's quite significant. You could have lost out on, 100, 200K worth of growth on a property that you might have purchased instead. If you want to get into crypto or stocks or shares, by all means do so, but do it with other capital that you might have not allocated towards your plan to building out that journey of what you actually want to achieve over the long term.
Incredible advice, mate. And it just strikes me all the time where often the best advice is actually quite simple, right? The get rich quick stuff is not the stuff that really serves us. It's about figuring out what we want. And as you say, reverse engineering we're to get there, and not being distracted by shiny things like crypto along the way, unless that's discretionary investment money that you've planned. So, mate, it's always a pleasure having you on. Thanks for sharing your insights from your corner of the world. I'm sure a lot of people get a lot out of that.
Mate, I appreciate it. I always love coming on. I always love seeing your face. And yeah, I'm excited, given the last discussion we had about about language models or machine learning even. I'm pretty excited to see where we land in another 2 or 3 years and see what the conversation's going to be like then.
Well, keep your phone on, mate. We'll have you back, and we'll see where the lay of the land is. Cheers, buddy.